He never invented an app. He never sold crypto. He eats at McDonald's. Yet Warren Buffett built $169 billion. Not by being flashy, by being patient. Warren Buffett didn't get rich overnight. That idea alone already separates him from most people who talk about money today. Before the headlines, before the billions, before the nickname Oracle of Omaha, there was just a curious kid trying to understand how money really works. At 11 years old, while most kids were spending allowance on candy or toys, Warren Buffett did something unusual. He bought his first stock. It wasn't a massive investment. It wasn't perfect timing. In fact, the stock went down shortly after he bought it. But that moment planted something powerful in his mind. He realized that money could work for you even when you are doing nothing. That lesson stayed with him. By the time Buffett was 13 years old, he wasn't just earning money. He was tracking it. He filed his first tax return. Think about that for a second. At an age when most people don't even know what taxes are, Buffett was already treating money seriously. He wasn't guessing. He was measuring. He was learning how income, expenses, and profit actually function in the real world. This wasn't luck. This was curiosity mixed with discipline. Buffett wasn't born rich. He wasn't surrounded by hedge fund managers or Wall Street elites. What he had was a strange obsession with numbers, businesses, and long-term thinking. While other teenagers dreamed about quick success, Buffett spent his time reading financial reports and studying companies like stories. He wanted to know how they made money, how they lost money, and why some survived while others disappeared. By his early 20s, Buffett had already figured out something that most people never fully understand, even after a lifetime of working. He learned one simple rule: money grows when time is on your side. That idea sounds obvious today, but living by it is rare. Most people chase fast money. They want results now. They want returns this month, this year, or even this week. Buffett saw that mindset as dangerous. He understood that rushing money decisions usually leads to emotional mistakes. Fear, greed, panic, overconfidence. Instead of asking, how fast can I get rich? Buffett asked, how long can I stay invested? That question changed everything. In his early career, Buffett didn't look for excitement. He looked for value. He searched for companies that were boring but strong. Businesses with real products, loyal customers, and steady cash flow. He didn't care if they were popular. He cared if they would still exist 20 or 30 years later. This is where most people get it wrong. They believe success comes from timing the market perfectly. Buffett believed success comes from staying in the market long enough. He wasn't trying to beat everyone tomorrow. He was planning to win slowly. Buffett once said that the stock market is a tool for transferring money from the impatient to the patient. And even in his 20s, he lived by that idea. While others jumped in and out, Buffett stayed put. While others panicked during downturns, Buffett stayed calm. He didn't ignore risk. He respected it. That's another reason his journey matters. Buffett didn't take reckless bets. He avoided businesses he didn't understand. He skipped trends that looked exciting but made no sense long-term. When people around him rushed into hot opportunities, Buffett often did nothing at all. And doing nothing at the right time turned out to be one of his greatest strengths. By choosing patience over speed, Buffett allowed time to do the work that talent alone never could. Every dollar he invested early had decades to grow, compound, and multiply. While others reset their progress by chasing the next big thing, Buffett kept stacking small, steady gains on top of each other. That's why his story doesn't start with billions. It starts with habits. Habits of learning. Habits of patience. Habits of thinking long-term in a short-term world. Most people chase fast money. Buffett chased decades. And that single decision shaped everything that came next. Warren Buffett follows one rule that sounds almost too boring to work. Buy great companies. Hold them forever. That's it. No secret formulas. No complicated charts. No non-stop buying and selling. And yet, this simple idea built one of the largest fortunes in history. Most people think investing is about action. They believe success comes from doing more. More trades. More timing. More predictions. Buffett believed the opposite. He believed the smartest move is often to do less. Buffett doesn't wake up wondering what to buy today. He doesn't stare at screens all day. He doesn't chase trends or react to breaking news. Instead, he spends his time studying businesses like a long-term owner, not a short-term trader. That mindset changes everything. When Buffett looks at a company, he doesn't ask, "Can I sell this for a profit next month?" He asks, "Would I be happy owning this business for the next 10, 20, or even 50 years?" If the answer is no, he walks away. That's why his portfolio looks boring to most people. Companies like Coca-Cola, Apple, and American Express don't sound exciting. They aren't startups. They don't promise overnight returns. But they have something far more powerful: strong brands, loyal customers, and the ability to survive economic storms. Take Coca-Cola. People have been drinking it for over 100 years. Recessions come and go. Wars happen. Markets crash. But people still buy Coke. Buffett saw that stability and understood its value. He didn't just invest. He committed. Apple is another example. Many people think Buffett bought Apple because it's a tech company. That's wrong. He bought Apple because it's a consumer brand with massive loyalty. Once people enter the Apple ecosystem, they rarely leave. That kind of relationship with customers creates long-term cash flow, and Buffett loves predictable cash flow. American Express fits the same pattern. Trust, reputation, brand power. Businesses and consumers rely on it. That reliance turns into consistent earnings year after year. Buffett isn't guessing. He's choosing certainty over excitement. Another key part of his strategy is what he doesn't do. He doesn't trade daily. He doesn't jump in and out of positions. He doesn't let short-term price movements scare him. In fact, he once said that if the stock market shut down for 10 years, he would be perfectly fine. Think about that. Most investors panic if the market drops for 10 minutes. When markets crash, people sell out of fear. Prices fall, headlines scream, and emotions take control. Buffett sees those moments as opportunities. When others are desperate to sell, he is calmly buying. Why? Because a falling stock price doesn't mean the business is broken. It often means people are scared. Buffett separates price from value, and that ability has made him billions. During major market crashes, while others were watching their portfolios bleed, Buffett was quietly increasing his ownership in great companies. He understood that temporary fear creates long-term bargains. This is where emotion destroys wealth. Fear makes people sell low. Greed makes people buy high. Buffett avoids both by staying logical. He doesn't let excitement push him in. He doesn't let panic push him out. His decisions are based on fundamentals, not feelings. That emotional control is rare, and it's worth more than intelligence. Another reason his strategy works is time. By holding companies for decades, Buffett benefits from compound growth. Profits get reinvested. Businesses expand. Dividends increase. Over time, small gains turn into massive wealth. Most people interrupt this process. They sell too early. They take small profits and reset the clock. Buffett lets the clock keep running. He once compared selling a great business too early to cutting down a tree just as it starts producing the most fruit. That patience alone separates him from a crowd. Buffett also understands that non-investing is sometimes the best decision. If he doesn't find a great opportunity, he waits. He's comfortable sitting on cash. He doesn't feel pressure to always be involved. That restraint protects him from bad decisions. In a world obsessed with speed, Buffett chose endurance. He didn't try to win every year. He tried to win over a lifetime. And that's the real secret behind his simple strategy. It's not about complexity. It's about consistency. Not about being busy. About being right and staying right for a very long time. That patience, repeated over decades, didn't just grow his money. It multiplied it into billions. Here's the part of Warren Buffett's story that shocks almost everyone. More than 90% of his wealth came after the age of 50. Let that sink in. This is the same man who started investing as a child. The same man who understood markets in his 20s. The same man who was already successful long before middle age. Yet the vast majority of his money showed up later. Why? Compounding. Compounding is not exciting. It doesn't feel dramatic. There's no big moment where everything suddenly changes. Instead, it works quietly, slowly, and relentlessly. It's money making money, and then letting that money make even more money, again and again, without interruption. Most people underestimate compounding because they focus on the beginning. In the early years, growth looks small. A few percent here. A modest return there. Nothing impressive. That's why many people quit. They don't see results fast enough, so they move on to something else. They chase higher risk, hoping for faster rewards. Buffett didn't. He understood that compounding doesn't reward impatience. It rewards endurance. Imagine pushing a heavy snowball. At first, it barely moves. You feel like your effort isn't working. But as the snowball grows, every push adds more weight, more speed, more momentum. Eventually, the snowball starts moving on its own. That's compounding. In Buffett's case, decades of small, consistent gains created unstoppable momentum. Early in his career, Buffett wasn't making billions. He was making steady returns. Year after year, he reinvested everything. He didn't pull money out to show off. He didn't reset his progress by chasing something new. He let the process continue uninterrupted. That's the part most people miss. Compounding only works if you don't interrupt it. Every time someone sells too early, panic sells, or jumps to a new strategy, they break the chain. The clock resets. The snowball shrinks. Buffett avoided that mistake by staying invested and staying calm. Another reason compounding worked so well for him is time. Buffett gave his investments something extremely valuable: decades to grow. Time allows mistakes to recover. Time smooths out volatility. Time turns average decisions into extraordinary results. This is why talent alone is overrated. There are investors smarter than Buffett. There are people who understand finance deeply, predict trends accurately, and react quickly. Many of them still fail. Not because they lack skill, but because they lack patience. Buffett didn't try to be the fastest. He tried to be the longest lasting. Small gains, repeated long enough, beat big risks every time. This idea sounds boring, but it's deadly effective. While others chased huge wins and suffered huge losses, Buffett aimed for reasonable returns and avoided permanent damage. He focused on not losing money first. Growth came second. That mindset allowed compounding to do its work without setbacks. Losses slow compounding dramatically. Big losses can destroy it completely. Buffett's caution protected the engine of his wealth. By the time Buffett reached his 50s, the results were impossible to ignore. His investments had grown large enough that even modest percentage gains produced massive dollar amounts. What once felt slow suddenly felt powerful. At that stage, compounding becomes visible. A small percentage on a huge base creates enormous growth. That's why most of Buffett's wealth arrived later in life. Not because he suddenly got smarter, but because the machine he built early finally reached full speed. This is a lesson most people learn too late. They think success comes from intensity. Buffett showed that it comes from consistency. They think they need a breakthrough. Buffett relied on repetition. They think they need talent. Buffett relied on time. Time did the heavy lifting. That's why Buffett often says that the best investment you can make is to start early and stay invested. Not perfectly, not aggressively, just consistently. Compounding doesn't care about excitement. It doesn't care about headlines. It only responds to two things: patience and time. Buffett gave it both. And that's how ordinary decisions, repeated over decades, turned into extraordinary wealth. Not through magic, not through luck, but through compounding, quietly working in the background, year after year, until the numbers became impossible to ignore. One of the most surprising things about Warren Buffett has nothing to do with stocks, markets, or billions of dollars. It's how he lives. Warren Buffett still lives in the same house he bought in 1958. Same neighborhood, same simple lifestyle. No private islands, no mega yachts, no gold-plated cars. For someone worth hundreds of billions, this makes no sense to most people. But to Buffett, it makes perfect sense. Because Buffett never saw money as a tool for showing off. He saw it as a tool for building more value. While others use money to impress strangers, Buffett uses money to buy ownership in great businesses. That difference might sound small, but over time, it creates a massive gap in outcomes. Most people fall into what Buffett calls the lifestyle trap. As income increases, spending increases even faster. Bigger house, better car, more expensive habits. The problem is not enjoying money. The problem is letting lifestyle growth eat up future opportunity. Buffett understood this early. He realized that every dollar spent on unnecessary status is a dollar that can no longer compound. And once compounding stops, wealth slows down. Or worse, disappears. So Buffett made a conscious decision to separate comfort from excess. His house is comfortable. His life is simple. His needs are limited. That simplicity gives him something most rich people never have: financial freedom without financial pressure. Because he doesn't need to maintain a flashy lifestyle, Buffett doesn't need to chase returns to fund it. He doesn't take risky bets to keep up appearances. He doesn't feel trapped by his own success. This discipline shows up in every part of his financial life. When Buffett makes money, his first instinct isn't to spend it. It's to reinvest it. He upgrades his portfolio, not his image. Over decades, this habit quietly multiplied his wealth, while others were stuck maintaining expensive lifestyles. Look around and you'll see the opposite everywhere. People earn more, but feel poorer. They upgrade everything except their financial foundation. They look rich, but live paycheck to paycheck. Buffett avoided that cycle completely. He once said that if you buy things you don't need, soon you'll have to sell things you do need. That idea guided his choices for decades. Instead of chasing luxury, he chased long-term ownership. That ownership paid him back many times over. Discipline also protected Buffett from emotional decisions. When markets were booming and everyone was spending, Buffett stayed calm. When markets crashed and fear took over, Buffett stayed calm. His lifestyle didn't change with the market, so his decisions didn't either. That stability is powerful. Because when your lifestyle depends on constant growth, every downturn feels like a threat. When your lifestyle is stable, downturns become opportunities. Buffett could afford to wait. He could afford to be patient. He could afford to think long-term. Another reason this matters is sustainability. Wealth is not just about making money. It's about keeping it. Many people earn large amounts and lose it just as fast. Buffett's discipline ensured his wealth had nowhere to leak. No lifestyle inflation. No financial pressure. No forced decisions. Just steady growth. This is why Buffett's wealth grew quietly. There were no dramatic moves. No headlines about wild spending. No sudden shifts in behavior. His life stayed consistent while his portfolio expanded. And over time, that contrast became extreme. A simple man with extraordinary wealth. The lesson here isn't to live poorly or deny yourself happiness. It's to understand the trade-off between short-term pleasure and long-term freedom. Buffett chose freedom. He chose ownership over appearance. He chose patience over status. He chose discipline over lifestyle upgrades. That discipline didn't just save money. It preserved compounding. And preserving compounding is one of the most powerful financial moves anyone can make. While others upgraded their lifestyle, Buffett upgraded his portfolio. And that quiet discipline kept his wealth growing, year after year, without noise, without stress, and without slowing down. When people look at Warren Buffett's success, they often assume it came from extraordinary intelligence. They imagine complex formulas, secret strategies, or genius-level predictions. But that's not the real reason he won. Warren Buffett didn't win because he was smarter than everyone else. He won because he was consistent. Consistency is not exciting. It doesn't make headlines. There's no moment where it feels impressive. But over time, consistency beats almost everything else. Buffett showed that showing up with the same disciplined behavior year after year is more powerful than talent without patience. Buffett didn't keep changing his approach. He didn't jump from one strategy to another. He didn't reinvent himself every few years. He found what worked early, and then he stayed with it for decades. That stability created momentum. The first lesson is simple but uncomfortable: start early. Buffett didn't wait for the perfect moment. He didn't wait until he felt ready. He began as a child, learning through small decisions. Those early years gave him something money can't buy later: time. Time allows mistakes to recover. Time allows compounding to work. Time turns average choices into powerful outcomes. But starting early alone isn't enough. Buffett also invested simply. He avoided complexity. He stayed away from businesses he didn't understand. While others tried to sound smart, Buffett focused on being clear. Simplicity helped him stay confident during chaos and calm during uncertainty. The next lesson might be the hardest: avoid emotion. Markets are emotional machines. Fear and greed push people into bad decisions every day. Buffett trained himself to ignore noise. He didn't let headlines control him. He didn't let panic force him to sell. He didn't let excitement force him to buy. Emotional control protected his capital, and protecting capital protected compounding. Buffett understood that losing money hurts more than making money helps. A big loss can erase years of progress. So instead of chasing huge wins, he focused on avoiding huge mistakes. That mindset alone put him ahead of most investors. Then there's the final piece: let time work. Buffett gave his decisions time to play out. He didn't rush outcomes. He didn't measure success weekly or monthly. He measured it over decades. Time became his partner, not his enemy. This is where most people fail. They want results now. They want proof quickly. When progress feels slow, they quit. Buffett stayed. He stayed invested. He stayed disciplined. He stayed patient. You don't need luck to build long-term wealth. Luck fades. It comes and goes. What lasts is behavior. What lasts is patience. Buffett didn't rely on being in the right place at the right time. He relied on being prepared and staying consistent long enough for opportunities to compound. Another important lesson is that wealth is not about intensity. It's about sustainability. Doing something reasonable for a very long time beats doing something extreme for a short time. Buffett never burned out because his approach was calm, simple, and repeatable. That's why his success looks boring from the outside. No dramatic moves, no sudden jumps, just steady progress. And that's the point. Warren Buffett built $169 billion not by chasing excitement, but by avoiding mistakes. Not by trying to be brilliant, but by refusing to be reckless. Not by winning fast, but by staying in the game. The real lesson is this: you don't need to be special. You need to be consistent. You don't need perfect timing. You need patience. You don't need complex strategies. You need discipline. Start early. Invest simply. Avoid emotion. Let time work. That formula doesn't look impressive in the short term, but over a lifetime, it becomes unstoppable. That's how $169 billion is built. If this story helped you see money differently, hit like. If you want more real lessons from the world's smartest investors, subscribe. And if you believe patience beats hype, follow for what actually works. See you in the next one.